Let's start. So we are doing sources of finance. Okay. I said that there is something called as debenture, if you remember. Correct. When I say debenture, debenture is what? Debenture is what? Debenture means company is raising a fund, okay, by complying the all legal requirements. Correct now? So they have some SEBI guidelines. You have to fulfill that, and you have to follow all those guidelines, and you have to issue the debenture. Debentures are normally secured. Okay, normally secured. Okay, generally they are secured as compared to uh, preference. Okay, or I should say equity. The rate of interest will be more or less. What do you think? The interest what we pay on debenture will be more or less as compared to preference and equity. It will be less as compared to equity and preference. What the interest on debenture you get is less. Correct? What you pay is less as a company. Okay, and there are many debentures are coming with many options. Like options means sometimes convertible option is there. Okay, convertible means what? Convertible debenture means what? It can be converted into shares. Okay, partly converted means half will be converted into shares, half will be redeemed. Redeem means cancelled. They will pay back your money. Okay, irredeemable means continuously it will go on. If you remember in the basics, I gave one sum where the bond was irredeemable. Okay, debenture was irredeemable means what? Till lifelong, till the company winds up. Okay, they will go on paying you interest. Please understand. Irredeemable means what? Not cancelable. Once it is issued, they have to pay, the company has to pay the interest till the winding up. Correct? Same like equity. There are some term used. Do you know what is face value? Do you know what is face value? The nominal value or the par value at which the debenture is issued. Generally it is rupees 100, or it is 1000, or it is rupees 1000. Okay, this is the general figure, face value. Okay, then you have coupon rate. Coupon rate is the interest rate on the bond. Coupon rate is what? Interest rate on the bond. Okay, so we call it coupon rate. Coupon rate, that is the what interest you get. Fine. Then what is maturity? Yeah, when they are to be redeemed. For how many years the debentures have been issued? 5 years, 10 years, 15 years, 20 years, 30 years. Okay, that is maturity. Fine. So bond or debenture now, they are usually issued for a specific period of time. Okay, so they are issued for a specific period of time. So there is a maturity for that. Correct. What is redemption value? The value which you will get where the company pays to the investors at the time of redemption. At the time of redemption, if let's say the face value is 100, the redemption can be 110, 120, means it is redeemed at what? Premium. You will get after 5 years or 10 years, whenever it is redeemed, you will get how much? You will get 110. Is it clear? What is market value? What is market value? The price of at which the bond is currently sold or bought or traded in the stock exchange. Like we have a good equity stock market, same way bond market is also there in US. Okay, bond means active bond market is there in US. Okay, so it reflects what? Current market expectation. Okay, market value, market value, will it be same as par value or redemption value, or it will be different? It may be different. Okay, it may be different. Is that clear? Okay, so then what is bond? So bond generally is what? Fixed income security created to raise fund. Same. Okay, it's almost the same. So now bond, sometime na bond and debenture does not have any difference, but in Indian parlance na bond are issued by government, it is said. It is not necessary. Now recently also IIFL issued a bond. Okay, so alternatively it is used, so don't get confused. Okay, so listen carefully. Bond as option. Bond as what? Option. Now what is bond option? Based on option, bond are classified into two. One is callable, one is what? Callable bond. When I say callable bond, it has a option. Option means, listen carefully, it's very new for you. Anybody knows what is call option? The what? Derivative instrument. It's a derivative instrument, means option. Here let us keep it simple. When it will come, I will explain what is options. Okay. Now it's a derivative instrument, but here we are saying callable bond. Okay, callable means what? The company has the right. The company has the right. I am the company. You are the investor. I have the right to call the bond, before the redemption. The bond is issued for 10 years. Bond is issued for 10 years. After that, any time, after 3 years, this 3 years is lock-in period. Once the 3 year is passed, any time I can redeem the bond. If the bond contract has this option, it is called callable bond. It is called callable bond. With whom the option lies? With whom the option lies? Call option. No, not the debenture holder. With the company, with the issuer. What we call? Issuer has the option. Now, when the issuer has the option, the debenture holder, he has the obligation. Therefore, it is called option. The another party has obligation. Is it clear? When the bond can be called, okay, after the cooling period, this is also called cooling period. Once the cooling period is over, 3 years, after that any time they can make a call. Okay, actually the maturity is 10 years, but they will not wait. Intelligent question. Will the bond be redeemed at premium if they are calling it early? Yes or no? Yes. Obviously, the bond will be called at premium. Please understand. See, obviously, if you have that option now, then only the bondholder will be ready to buy. These are all is decided at 0th year, today itself. That after 3 years, anytime I can call the bond. But at what rate I will call? I will be obviously call not at face value. Nobody will buy your bond. Why they will buy your bond? If you are calling it at premium, then only the people will buy, na? Are you understanding? So generally the call, these things, the bonds, callable bonds are issued at, callable bonds are called at premium. It is called call price. What it is called? Call price. We call it call price. Okay. Now here the option was with whom? With issuer. Option is with whom? Issuer. Same way. Putable bond. Putable means if I am the investor, I will put. If I am the investor, I will put. Means I will sell the bond after 3 years at any point of time. That means who has the option to put the bond? Who has the option? Debenture holder or bond holder has the option. Bond holder has the option. Bond holder has the option to put the bond. Bond holder has the option to put the bond. To sell it back. To whom? To the company. Who has the obligation? Obligation means compulsory. Compulsion. For whom it is compulsion? For company to buy the bond. If investor says, now these all things are decided today itself. I am a company. I want to issue putable bond. Putable bond means what? I am giving right to the investor. Anytime after cooling period, if you want, you can sell the bond to the company back. Okay. My question is, bonds are traded in the market. You can sell it in the open. You can sell it in the open market also. Okay. Yeah, say. No, you are not understanding. Listen, one is open market. Listen carefully. One is open market. Open market you can sell, no problem. If you are comfortable with the price what you are getting, you can. But this bond is special bond. These two types of bond are special bond. What are these two types of bonds are special bond? What is the special about this? In the bond contract, it is said in the callable bond, if the company wants, it can redeem the share, it can redeem the bond at any time. And in putable bond contract, it is written any time after the cooling period, the investor can sell. It is obligation for the company. In putable bond, it is obligation. In callable bond, it is obligation to the investor, okay, to sell the bond. Yeah, only debenture holder and company is involved in this. Okay, and it is, these are, see, listen, be make a broader view. These are all decided in the zeroth when it is issued itself. Now my question is, why a person, why the company will call the bond? Think now logically, why the company will call the bond? To reduce the debt. What Reliance did in lockdown? Correct na? Redeem the debt. And they are targeting debt free. They will be debt free, they are saying. Correct. Now that is correct. They are debt free. They are already debt free. Now, no, someone was saying that they will be debt free. No. One more company recently has said in 2021 we will be debt free. I don't remember exactly, but someone has said. Wait. Let me recall and I will tell you. Acha, tell me why the company will call the bond. What will be the situation when the company will be called? That is okay. That they have to reduce the debt. That is fine. That is one reason. Anyone, na? See, I am carrying an individual and a company. For everyone, the rule of the game is the same. If I am having a home loan, obviously I will think to clear it off as soon as possible, isn't it? My question is, when the company will call the bond? So the answer for that, when the interest has gone down, when the interest rate has gone down, I already issued a bond on which I am paying 10%. I am paying 10%. Okay, so what I will do, I will call the bond on which I am paying 10% and I will issue a new bond. Now because the interest rate has gone down to 8%, I will issue a new bond at 8%. People are buying because market the interest rate is down. Once the rate 10% is decided with the bondholder, can you reduce it? No. But what you can do, if it has a callable option, if the interest rate goes down, what you will do? You will call your old bond and you will issue a new bond at 8%. So by this, what will happen? Because of this, what will happen? Why company will do this? To reduce the interest cost. Very good. To reduce the interest cost, my interest cost will get reduced. Putable bond. When the investor will put the bond, when the interest rate when interest rates are high. See, I bought a bond as an investor. I bought a bond. They are paying me 10%. But outside the market, new bonds are coming up with 12%, 13%. So what I will do? I will put this bond, sell this bond. Okay, and I will buy the new bond at 12%. Correct? Now these are the reasons. Correct? So these were the different types of bonds. There is also government bond. Okay, there is also government bond. This is Indian bonds. All I am discussing about Indian bonds. Government bond means what? Issued by government. That is government bond. Okay, they are actively traded. They are actively traded in money market. What is money market? Where the short-term money market. Please understand. Money market means what? We should know all these things. What is money market? Where the short-term securities are traded. In that, government bond also trades. Then there is something called as municipal bond. Municipal bond is what? Issued by municipality. BMC, like Bombay has BMC. Okay, to finance the urban infrastructure. You might also be in your city, you might also be having municipal corporation. Correct? So they also issue the bond. So that is municipal bond. Okay. Then there is something called as masala bond. What it is? Masala. Masala means what? Spice. Masala means what? Spice. It is the Indian name. Indian name. Understand? Indian company. Understand? Indian company is issuing this bond outside India. Where? Outside India. Please understand. Outside India. Okay. The bond is in rupees. The bond is in rupees. Indian company, Reliance, issuing in Dubai. The bond is in rupees. It's called masala bond. Why? Why it is called masala bond? Indians have given the name because we used to sell the masala, na? Britishers, why they came to India? To buy masala. Now we will sell you masala bond. Come on, take it. Understood? To have that flavor, they name it masala bond. Is it clear? Masala bond. Next. Now understand, these were Indian bonds. I am going to foreign bond. Foreign bond. There is something called as, yes, foreign bond. In foreign bond, plus first one is plain vanilla bond. We have no ice cream, vanilla. Plain vanilla bond. Plain vanilla bond means what? Basic bond without any option. Call option is not there. Put option is not there. Issuer will regularly, the company will regularly pay you the interest. Okay. This can be issued at discount also. Discount means 100 rupees bond issued at 90. Initially they will issue at 90. Redeemed at premium or par, whatever it is. These are called coupon bearing bond. What it is called? Coupon bearing. Coupon means you will get interest. You will get interest. Like let's say 100 is the face value. 10% is coupon. So 10, 10, 10, 10. For 5 years you will get 10. And let's say it is going to be redeemed at par. So at the 5th year you will get 100. Or if it is at premium, you will get 110, 120, whatever it is. Is it clear? This is called plain vanilla without any option. If there is option, then it can be callable, putable, as we have seen. Next is foreign currency. Foreign currency convertible bond. Foreign currency convertible bond. Now foreign currency convertible bond is issued in currency different than the issuer's domestic currency. Please understand. Like Indian company, issuer is who? Indian company. I am repeating. Indian company. Issuer is who? Indian company. Okay. But the bond is issued in currency different than the issuer's domestic currency. Our currency is what? Rupees. But we are not issuing the bond in rupees. We are issuing the bond in dollar. Okay. So the money raised by the issuer is in the form of what? Foreign currency. The investor will pay in dollars. I am Indian. I am issuing somewhere. Okay. But it is issued not in rupees. It is issued in what? Dollars. Is it clear? Foreign currency, FCCB, foreign currency convertible bond is convertible bond with a very low rate of interest. The rate of interest is what? Low. Okay. So what happens? You get the foreign currency. You get the foreign currency at a very low cost. At a very low cost. Let's say I am an Indian company. I want to pay someone 1 lakh US dollars. So I issue a bond. Okay. In what? In dollars. Okay. So I get dollars. So at a very low cost, I get the dollars. Okay. Here also interest will be paid. Means coupon will be paid. Principal payment will be done. Okay. But they have the option. But this bond have an option of what? Convertible. Means what? The bonds can be converted into what? Bonds can be converted into shares. Okay. If the price is advantageous, if they are thinking that share price is going to go up, the investors will convert the bond into what? Shares. Is it clear? Should I explain again? In foreign currency convertible bond, who is the issuer? Any domestic issuer or Indian company issues the bond in another currency other than his domestic currency. Like let's say Sony company, domestic currency is what? Sony is which company? Japanese, Japan's currency is what? Domestic currency. Yen. Japan's currency is yen. Now Sony is issuing in US or somewhere in US dollar, or let's say CAD. What is CAD? Purposely I am using this. What is CAD? Canadian dollar. So Sony's home currency is yen, but they are issuing bond in what? Canadian dollars. So it will be called what? Foreign currency convertible, and it will have an option that after certain period, investor can convert his bond into what? Shares. Convertible floating rate note. Convertible floating rate note. Now what is convertible floating rate note? Now this convertible FRNs. Convertible floating rate note. So what is convertible floating rate note? Convertible floating rate note means it is issued with an option to the holder to meet its long-term debt. Okay. To meet its long-term debt security with a specified coupon. Okay. Understand what I'm saying? Please understand. Investors are protected against the falling interest rate. What is convertible floating rate note? Understand. Investors are protected against the falling interest rate. Means what? These are the notes. Now let us try to understand what is floating rate. Now what happens? What is famous? That I am discussing. What is famous in the global market is LIBOR. LIBOR is what? LIBOR is what? London interbank offer rate. London interbank offer rate. Okay. London interbank offer rate is LIBOR. In London, what the banks are offering to each other, loan to each other, what is the rate? That rate is called LIBOR. That rate is called what? LIBOR. Okay. What is LIBOR? LIBOR is London interbank offer rate. There are banks in London because it's the financial hub. London is the financial hub. What the banks are offering to each other, what rate of interest they are offering to each other is called LIBOR. Okay. Now when I say floating rate note now, so it is floating rate note means what? Floating rate note means what? Now the rate is not fixed. Like in debenture we say 10%. Here the rate is like this. LIBOR plus 3. This LIBOR, this LIBOR is decided by London Interbank, and every 6 months they decide. Means what? In Jan they will decide for next 6 months what will be the rate. In July 1st they will decide what will be the rate for the next 6 months. So every 6 months the rate keeps on changing. The rate keeps on changing. Is it clear? Understood? So it is called convertible floating rate note. What it is called? Convertible floating rate note. Correct. And why it is called convertible floating rate note? What is note? Can anybody tell me what is note? Note means what? Sorry. What is note? No, it is not short description. Someone is saying short description. It is not short description. We are not talking about that note. Okay. Any other note which you have heard? Promissory note have you heard? Okay. And what else? Any other note? Any other note which you have heard? Huh? Debit note. Good. Okay. Listen. Now what happens? Now what is this foreign convertible note? Note means what? I will tell you. There are some medium term notes introduced in recent time. Means when the period is less than 7 years now, when the instruments are issued, similar to bond, but the instruments are issued, but the instruments, see, everyone na, they try to give, like India gave masala bond na, same way everyone na, they try to give their own name. So company, what they does, they change some of the features and they try to give it a new name. So what is note? when the security, when the debenture is or bond, or I'm just I'm not using it purposely, means it's not in a strict manner I'm using it. Take it very leniently, in a very casual way. I'm talking about debenture. I'm using the word debenture. A debt issued, a debenture in debt instrument issued for how many years? For 7 years. Medium term, that is called as note. That is called as note. Okay. So now what happens, I will tell you. Why it is called convertible, you know. As I said, when I say notes, now see, they have not given all these things in the book. What is notes? Notes means it is issued for medium term. Now this medium term debt can be converted into long term. Therefore it is called convertible. Therefore it is called convertible. Okay. And why it is called floating rate? Because the rate is not fixed. The rate is L plus 3, like that. Okay. LIBOR plus 3. Every 6 months, the bank decides the LIBOR rate. So accordingly, what they do? They decide the rates. Please understand. If LIBOR is 5, then you will get how much? 5 plus 3? 8. Correct? 5 plus 3, 8. If next 6 months the LIBOR goes down to 6, so 6 plus 3, the LIBOR goes up. 6 plus 3 will be how much? 9. So you will get 9%. So it is like that. Fine. Yeah, 3 is constant. 3 is, means this I have taken assumption. LIBOR plus it can be 0.5%, it can be 1, it can be 2. I am just giving you an example. What is floating rate? It can be only L also. Only LIBOR, whatever is the LIBOR rate, that you will get. Floating rate, why it is called? Every 6 months, the rate is not fixed. Like in debentures, the rate is fixed now. Here the rate is not fixed. It will keep on changing. So it is called floating rate. Why it is called convertible? Because this note, this medium term note can be converted into long term debt. I'm telling you, in recent time, in modern, this finance now, modern instruments, they have started with medium term notes. Everyone, many countries have started with many corporate have started with medium term note. When I say note now, you have to understand it is for 5 to 7 years or something like that. Okay. It is not a long term. More than 7 years, it's note. Okay. Fine. Next, there is something called as drop lock bond. What? Drop lock bond. Now, what is drop lock bond? It is similar to floating rate note. It is similar to FRN, floating rate note. Similarly, normally floating rate. But the feature is what? Feature is what? You can convert this into fixed. You can convert it into fixed. When the interest rate goes down now, there is a option in which you can get converted into fixed. If the LIBOR goes on decreasing, you will get less interest, less coupon. So what you do? You get converted into what? Fixed. It is called what? Drop lock bond. If the interest rate drops, you can lock your interest at the fixed rate. Are you understanding? Correct. But these all things are predetermined. Initially only. Like LIBOR, if LIBOR goes down to 5%, then your instrument will get converted into what? Into fixed rate. Okay. You can earn fixed rate till what point? Till maturity. Once it gets converted. Is it okay? Then there is something called as variable rate demand obligation. Variable rate demand obligation. Yes. All this is given in the textbook. Okay. All, yes, you have to revise. Okay, I will not go on reading now. Variable rate demand obligation, or it is also called that variable rate demand obligation bond. Okay, or it is called VRDOs. VRDOs. Okay, variable rate demand obligation. Now here, the variable rate means what? Interest rate is reset periodically. Means bond is issued. Every, let's say we have decided every weekly or every 6 months, or every quarterly, initially it is decided that the rate will be this. So every 6 months or every, let us assume semi-annually, every 6 months the rate will change. It is reset. Therefore, it is called what? Variable rate security. Therefore, it is called what? Variable rate security. Okay. Now here also the holders, when I say holders, the bond holders have the right to sell back the security to the issuer at par, at any periodic rate. You can sell it back. So it is similar to what? It is similar to what? This bond is similar to what? We have already done. Putable. It is similar to putable. Investor has the right to sell the bond. It is putable. But in putable, the rate was fixed. But here, the rate is set periodically. See, what happened, I will tell you. First, bond came into the market. US and all. Bond came into the market. Please understand the story. These people used to come to India to trade. Okay, then slowly they formed the company. And when they used to come now, there used to be sea pirates and all. When they used to come to, these foreigners used to come to India for trade. Sea pirates used to loot them. They used to kill them. So these merchants formed a guild. This is the history. Merchants used to form the guild. Now, when the merchant used to come, initially he used to come. Before that, he used to come what? Alone. He used to sell in one market. He used to come in boat and all, big ships. And they used to come, they used to buy from here, they used to sell in one market, they used to earn. Whole profit was himself, for himself. Means whole earnings was the type of sole trader. Yes, means he used to earn. Whatever he has earned, it is his profit. Whatever is the loss is his profit. But then they started forming merchant guilds. They started forming group. Now the question arises that we will buy from one market, we will sell in one market, then how we will distribute the profit and cost and all. Okay, so share was given. You will get a share, how much you invest, the capital ratio. From there the joint stock company idea came. When the joint stock company, I have an idea, I want to form a joint stock company, I want to raise the issue from the public, I was to raise the money from the public. Please understand, I want to raise the money from the public. Okay, initially shares were not there, bonds were issued. So US, this all concept started in US. So the bonds US market is strong. US bond market is strong. US has a strong bond market, very good base. So what the corporates did, they slightly changed the features, give it a new name. This is similar to putable bond. The holder has the right to what? Sell the bond before the maturity. But the interest rate is not fixed, it is variable. It is set for every 6 months. Now you tell me, when the investor will put the bond? When the market interest rate is higher, here let's say after 2 years, here let's say after 2 years, here you got something 5%. Okay, but market interest rate is 10%. Obviously, you will exercise your option. Correct? And you will sell it to the issuer. Correct? Okay. Now this VRDOs they generate returns that have a low correlation with stock and bond. Okay. Low correlation. What do I mean by low correlation? Correlation is less with stock and bond. See, I'm telling you something very important part of the finance. Understand? You should invest in different types of instruments. Agree or not? You should invest in different types of why? Diversification, very good. Risk reduction, very good. You people are speaking like CA finance students, very good. That means diversification. Diversification means what? You are getting diverted. Why you are getting Why you are diverting your investments in different things? Because the risk get reduced. You keep the egg in one basket, and if the basket falls, you will lose all your eggs. So what you should keep, what you should do, you should keep your eggs in different multiple baskets or different nest. Correct na? So that something should be safe. So this we learned this people might be able to understand what I'm saying. Foundation student, we used to calculate R, correlation coefficient. What is correlation coefficient? Can anybody? In statistics, we used to calculate correlation coefficient. What it is? He is saying it's the increase or decrease of one parameter on the other. I will make it simple. It shows the relationship, how the relationship is strong. If I say, like simple, like let's say me and Sammy, we are very good friends. If we are very good friends, how our correlation will be high? It might be 0.9. If I say yes, she also says yes. If I say no, she also says no. Okay. And it is positive also. It is positive means we are having what? We are having a great relationship, means we are very positive. We are having friendship. Correct. It is like that. And if it is minus 0.9, and if it is minus 0.9 means what? If it is minus 0.9 means the relation is negative. We are not friends. We are enemies. India, Pakistan. And that too, the relation is how much? 0.9. Very near to 1. Very near to 1 means strong negative relationship. If India says yes, Pakistan will say no. India and Russia relation is very good. Strong correlation. They help each other in all aspects. So the correlation of the VRDOs are low. So when I put the instruments which has a correlation with the stock and bond, I have stock, I have other bonds. When I put in that portfolio VRDOs, my risk gets diversified. Because if stocks go low now, this VRDO will give me more return. And if the stock goes higher, the VRDO will go low. And it will, means anyway I will balance out. Are you understanding what I am saying? So ultimately I will earn. Next. I said that when you are diversifying now, I am not showing any relationship. I am just saying that this VRDOs have a low correlation. So if the correlation is low, that means what? If I put this in my basket now, my risk will get diversified. Whatever it is, means with stock and bond, it has a correlation. Okay. Next, yield curve note. Next is what? Yield curve note. Yield curve note. Yield curve notes, the rate is fixed. The rate is what? Fixed. Sorry, the maturity is fixed. These have a fixed maturities. Okay, they have the fixed maturities. Now what happens? The coupon rate, the coupon interest, the rate that varies inversely with the level of short-term interest rate. They provide a coupon interest. They provide a coupon interest that varies inversely with the short-term interest rate. If short-term interest rate is high, yield curve will give you low interest. Okay. Maturities are fixed. So if short-term interest rate is low, this will give you more. Okay. Now what does this mean? If the market interest rates are going up, the yield curve note, this note will give you what? Low interest rate. And if it is going down, then it will give you high interest rate. Okay. Why? Why? This security is bought by whom? This security is bought by people who want to hedge the risk. Who want to hedge the risk? Hedge the risk of what? Of the interest rate. Please understand. Who will buy this? Understand, there is someone called as hedger. Do you know who is a hedger? Anyone? Who is a hedger? In market, who is a hedger? Okay, let me explain. Listen, a person who comes into the market, to reduce his risk is a hedger. Is a hedger. Please remember this. I will explain you later also with the examples. But who is a hedger? Who comes to the market, who takes the position to reduce the risk is called hedger. Okay? The person who comes to earn profit and to make profit, okay, without any intention to reduce the risk is called speculator. Means if I am, see, listen, a farmer, a farmer is entering into a commodity market. Now he is a farmer. So farmer will have the commodity after say 3 months. Okay. Now understand what I am saying. I am going deeper. Okay. What happens? I am a farmer and I think that the crops price will go down. The crops price will go down. Okay. Let's say today it is around 30 rupees per kg and I think the prices will go down. So what I do? There is a market called as forward market. There is a market called as forward market. Forward market means what? Where the buyers and sellers meet. The contract is for forward. I am a farmer. I want to make a contract after 3 months. So I go to the forward market. There is a person with whom I have a contract. What? I will sell you the wheat at 30 rupees per kg after 3 months. So is the contract what is the contract is executed today? The contract is done today. But when you will sell the wheat, when you will after 3 months, means we are having a contract, forward contract. We are having a forward contract. Buyer and seller meet. I will sell you the wheat after 3 months. I am who? I am a farmer. Okay. And the person agrees. Rate is also fixed. Quantity is also fixed. So that is called forward market. Sir, can we have such type of market? Can we have such type of contract? Yes, it is called forward market contract. So we decide that after 3 months that I will sell at this rate, you should buy at this rate. And it is done. Now what happens after 3 months? Let's say today is Jan. And after 3 months in March or April, when my crops are ready, market rate has gone down to 25 rupees per kg. But I to already have a contract, na? But I to already have a contract. At what rate I will sell? At 30. So I am contented at 30. Understand, please understand. If it goes up to 35 rupees per kg, then also I will have to sell at what rate? At 30. I have to be contented. Why I came into this forward market? This was my insurance, one type of insurance. I got insured at what? 30. I know that 30 is sufficient to me. I know that 30 is sufficient to me. So this is hedger. This is hedger. I came to reduce the risk. How? If it goes down, now what was my risk? The price is going down. What is the risk of the farmer? The price is going down. That is the risk of the farmer. Okay, if it goes up, then too is contented. I got 30. I am happy. If it goes down to 25, he will be happy. Why? Because he had a forward contract at 30. He is contented at 30. Are you understanding? Yes. Same. Futures is something different. Futures is something different. Futures is standardized forward contract. Casually I can say like that. But let me complete this. So this is forward contract. So why a farmer came to hedge? This is called hedging. If I am a teacher, I go and make a forward contract. Why I am going? I think that prices are going to go down. I make a contract. I make a contract to sell. I make a contract to sell. Okay. I am a teacher. I am not going to, after 3 months, I am not going to have the crops. So it means what? I'm not going to have the crops. It means what? It means I have come to earn the profit. I am thinking that the prices will go down and I will make a 5 rupees profit. Please understand. Huh? It's a speculation. So I am a speculator. Okay. So this is a protection. This is a protection. Please understand. YCNs are used to hedge the interest rate. To hedge the interest rate. If you are thinking that if you have borrowed, please understand, if you have borrowed money and the interest rate is going to go up, okay, please understand. So this instrument can be used to reduce the interest rate, because what happens, you will pay what, the lower rate. So you have hedged, you have reduced your risk, correct, right? There is something called as Eurobond. Now this has nothing to do with Europe. Okay, Eurobond, people write definition, it is issued in Europe, it is issued in pound. No. Eurobond is what? It's an international bond, okay, issued in Europe or else outside the country in which whose currency its value is stated. Means what? Let's say India is there, Indian company. For Indian company, what is the Indian currency? Rupees. Rupees. So Indian company will not issue the bond, okay, outside the country. Outside the country means not in India, outside. Let's say I am issuing in US company. Let's say I am issuing in US country. I am issuing in US country. Okay. This is an international bond issued in Europe or elsewhere outside the country in which whose currency its value is stated. Means what? In whose currency value it is stated. Means Euro bonds it is generally denominated in a currency other than the home currency of the country or the market in which it is issued. I might be issuing here what? In yen. Please understand. Okay. Please understand. Indian company, home currency is what? Rupees. My currency is rupees. I am issuing where? In US country. Correct. And I am using what? Yen. I am issuing it in what? Yen. Correct. Okay. Is it clear? If you have the notebook and all, those who have not understood Eurobond, once again, Indian company, the currency is rupees, but is issuing in US in yen, because US has which currency? Dollars. I am not issuing in dollars also. I am issuing in yen. So it is called Eurobond. It may be issued in Europe or anywhere outside Europe also. Okay. Now listen carefully what I am saying. Please understand. See, if you want, you should make in notebook whatever I am writing. Okay. I am making it in a table form so that you can understand it easily. Here, let me write type. Let me complete, then you can copy. Okay, I also don't know what I am going to write. Yankee bond. There is something called as Yankee bond. Now, what is Yankee bond? Yankee bond is issued in US. Where it is issued? US. Denominated in. This is denominated in US dollars. It is denominated in US dollars. Who is the issuer? Issuer is non-US company. Non-US company. Where it is issued? Where it is issued? In US. Where it is issued? In US. What is the applicable regulation? Obviously, where it is issued? US. So, whose regulations will be applicable? US. So, SEC regulation. SEC. Like we have SEBI, same way there is SEC. I should write it in capital. SEC. Securities Exchange Commission. What is the difference between first and the fourth point? This is the first, second, third, fourth point. What is the difference between the first? Okay, where it is issued means in which market. Like, let me change this. Wait. Okay, let me change it. To access the capital in, to access capital in, to access capital in. Now it should be clear. I want to access capital in what? In US. The place. There is a slightly difference. Okay, there is slightly difference. Please understand. When I am saying to access capital now, it is market what I am talking about. You are right. There is no major difference between first and fourth. But still I am writing it. To access capital in US market. I should write US market. Means to make it clear. Means what I am trying to do is I am trying to make a differentiation so that you can write in the exam. You should write Yankee bond. It is issued in US. It is denominated in US dollar. Okay. Generally the issuer is non-US company. Okay. It is issued to access the capital in US market like this. Applicable. Are you understanding what I am saying? You are correct. It's almost same. But to write the answer I am framing this. Applicable regulation is SEC, Securities Exchange Commission. Okay. Interest rate. Okay, or I will write other points. Other points. Other points. Other what points? Other points means here the interest rate is LIBOR. LIBOR is what? London Interbank Offer Rate. Okay, interest rate is LIBOR. I should write dollar LIBOR. What I should write? Dollar LIBOR. Okay, on dollar you will calculate the LIBOR rate. Okay, so done. This is one. Next is Samurai. Next is what? Samurai bond. Samurai is issued where? Is issued in Tokyo. Where is Tokyo? Japan. Where is Tokyo? Japan. It's issued in Tokyo, Japan. Okay. Denominated in what? JPY. Denominated in JPY. Japanese yen. Okay. Issuer is who? Non-Japanese company. Non-Japanese company. Why I am making this, you will understand. To access the capital where? Japanese market. Easier to by heart. Japanese market. Otherwise, 3 bonds. Sir, we have to remember 3 different. No. Simple. Samurai is what? Samurai. You know samurai, that huge. Samurai. Short. Japan. Simple. Yes. Ancient what? Ancient? Ancient swordsman something. I don't have that much. I don't have that much knowledge. So it is samurai. Okay. To fight with sword. Yes, ancient sword. So samurai means what? Issued in Japan. In Japanese yen. Who issues? Non-Japanese company. So Japan regulation has named it samurai. Okay. Then okay, you are issuing, you want to access the capital market where? Japanese market. So applicable this thing, regulation is Japanese regulation. Yes or no? Fine. Okay. Why it is other points? What you can write? Issue proceeds can be used. Issue proceeds, money can be used to fund Japanese company, okay, or any other operations if you want to do in that country, you can issue this bond. Next is bulldog. Okay, bulldog is breed from where? London, UK. Okay, denominated in what? What is the currency? London. GBP, Great Britain pound. Issuer is who? Non-UK company. You want to access what? UK market. Application regulatory will be what? UK, or I can say Great Britain market. You will have to follow the regulations. What is the other point that can be issue? Same. Issue proceeds. Please write it nicely. Can be used. Issue proceeds can be used to fund UK company, to fund UK company. Easy, isn't it? Please copy this. Copy this. Once you are done, please let me know. Done? Is it completed? Can we proceed? Okay. Listen. Now, based on the feature, based on features, I can classify bonds as, based on features, I can classify bond as DDB. DDB is what? Deep discount bond. What? Deep discount bonds. Deep discount bond. DDB. Now, DDB is what? Zero interest. Okay. It is what? Zero interest. Deep discounted. Please understand. Means the bonds are issued at very deeply discounted. For example, let's say the face value of the bond is rupees 1 lakh. Okay, is 1 lakh and is issued at what? Issued at 2700. So this is the issue price, deeply discounted. 1 lakh bond, face value is 1 lakh. You will get it for how much? Initially you have to pay 2700. Investors pay this amount. And let's say the holding period is 25 years. So today you pay 2700. After 25 years, you will get what? 1 lakh. Is the interest paid? No. Then what is the earnings to the investor? The difference. The difference of this. Is it clear, guys? Deep discount. Yeah, redeemed at par. Now sometimes there are variations. See, sometimes what the company does, they give you at regular interval, they give you the option to redeem at 5 year, 10 year, 15 year, 20 year. Before the maturity, you can get it redeemed. They give you the option sometimes. At regular interval, they can give you the option. Okay, is it clear? Fine. Next is what? You will have to check. I think IDBI. You'll have to check. I think IDBI. IDBI is issued. Please go and check. Second is, yeah, it's similar to zero coupon bond. It is similar to zero coupon bond. Only the difference is deep discount bond is the tenure is more. For deep discount bond is the tenure is more. Okay. And in zero coupon bond, the tenure. Let me complete. I'm coming to that. Zero interest. Zero interest. Fully convertible bond. See, the name itself says. Now this all features on the based on features. Now it is easy to explain. Zero interest means no interest you will get. Means there is no coupon. It does not carry coupon. Then bonds after certain period, bonds are compulsorily and automatically gets converted into what? Into equity share at predetermined price. Okay. The company shall convert it. How the company gets benefited? No interest is paid. So company is benefited with that. How the investors will get benefited? They will, if the equity shares has good value, okay, so they will become the owner. Yes, they will get a good return if the market price is high when it is getting converted after, let's say, 5 years, 7 years, 10 years. So they will get equity shareholder. At that time, if the price is high, they will get benefited. Is it clear? Okay. Secured premium note. Secured premium note. Please understand. When I say it is note, the maturity is what? Approximately 4 to 7 years. Approximately what? When I say note, it is for 4 to 7 years. Okay. Now this note are issued. This is similar to bond. Okay. Similar to bond. It is a note which has a sweetener. Sweetener means warrant. Sweetener means what? Warrant. This secured premium note is issued with warrant. It's a detachable warrant. What is detachable warrant? Please understand. Very important. Please understand. This warrant, in this warrant, you get an option. You get an option. This warrant, you get an option to convert your note, into equity share. Into equity share. So it is called warrant. I have issued a note which has warrant. Okay. Please understand. Obviously, at regular interval, you will be getting interest. Okay. But it has a conversion option. Fine. Sir, can we call it convertible bond? Obviously. But now the parallel has changed. Na? When it is for 4 to 7 years, medium, they call it note. And someone has given it a new name, that is secured premium note. It get converted. After a certain period, it get converted into equity shares. Now, if you have the secured premium note, okay, this is the first part, interest part. And this is the second part, that is warrant. You can sell the warrant. It is also trades in the market. When I sell the warrant, are you understanding what I am saying? When I sell the warrant, are you people understanding what I am saying? Two papers are there. One is first one. This is to get the interest. Let's say for 5 years I have issued the secured premium note. So for 5 years I can take the interest. Second is warrant. It is detachable. Warrant means what? That paper has the option to get converted into what? Equity share. So if I don't want the equity shares now, I can sell this paper. I can sell this part. It is detachable. So therefore, when the warrants are detachable, it is called what? Secured premium note. Are you understanding what I am saying? Bouncer? Was it a bouncer? I again explain. See, there are two parts. One is what? To get the interest. That is, it's similar to bond. But after a certain period, you have a warrant. If the warrant is attached, warrant means what? In finance, it is called sweetener. To attract. See, anyone now, you are the what I should say. First, you are the creditor. When you are giving a loan to the company, you are the creditor. Then after 5 years, you can become what? Owner. So to attract the investors, they attach warrant. And what happens? There are two papers. Warrant is also trading in the market. This interest strip is also trading in the market. You can sell that warrant. So that is called secured premium note. Okay. Why it is called note? Because the tenure is generally 4 to 7 years. Who creates all these names? That I also don't know. Every corporate creates their own names. Every company now. I said now our bond market is not that huge. US bond market is huge. So every corporate now they come up, they change the feature and they give the name. There are thousands of bonds. Thousands of bonds. Huh? Good that we don't have. Yes, in US CFA we have thousands of bonds. Fixed income. Are that subject first level to everything means all about bond only. Full subject. Okay. There is something called as double option bond. Double option bond. Now what is double option? Means once again, the double option, two separate certificate is there. Double option, two separate certificate is there. One is for principal, one is for principal. Let's say principal amount is 5,000 and another is for interest. Interest. Now this is for interest. Okay. So both these certificates are listed in the market. Double option bond. If you want, you can sell the principal. When you sell the principal now, at the redemption, you will not get the principal. The person who holds the certificate will get the principal. Are you understanding? Yeah, obviously it will trade at discount na. At the redemption, think na, present value factor. Think na, exactly. At the redemption, the person is going to get 5,000. So obviously he will not pay you more than 5,000. He will pay you less only. But you are in urgency. Okay, so you think, chal, let us sell it. So one certificate you can sell. If you don't want to enjoy, the what? The interest. If you don't want to enjoy the interest, sell that part. Okay. This both certificates trade in the secure stock exchange. Okay. Okay. Anytime you can sell any of the part. This was issued by IDBI. The face value at that time I think was 5,000. Okay. And interest rate was 15%. Fine. It was issued for 10 years. Then there is something called as option bond. Now what is option bond? Now anyone, what is option bond? In finance now, option market has two options, call and put. So people here tend to write callable and puttable bond. No. Please understand, no, don't write. Call and put na is option instruments, derivative instrument, call and put. So what they think option bond means callable and puttable. No. Please understand. Call and put na are called as option market. So here it is option bond na. So by the name itself, they say what? It is callable and puttable bond. They write in the exam. No, listen carefully. When you fill the form na for the bond, let's say you are buying a bond as an investor. You get an option. Option of what? Whether you want the interest 3 months at regular 3 months or semi-annually or annually or cumulative at the end of at the time of redemption. So this option is given. Are you understanding what I am saying? The bond has come up and a bond, I am a issuer. So I have given you the option whether you want interest, your coupon every 3 months or whether you want 6 months, every 6 months semi-annually or whether you want yearly or whether you want at the end when I will redeem. So that option is given. So that is called what? Option bond. Guys, are you understanding? Sure, na? Don't write puttable and callable. The person who has a knowledge of option market, na, who knows that call option, put option. So these are options. So he will write callable, puttable. No. Company gives you the option to get your interest at any specified interval. That is called option bond. Every bond does not allow you. Every bond it is not allowed. They decide. Company, sometimes the companies decide. Every 6 months we will pay the interest. So there you don't have the option. Is it clear? IDBI has issued this. IDBI has issued this. ICICI has issued this option bond. Okay. There is something called as inflation bond. So many bonds. Inflation bond. Okay. What happens? The coupon is adjusted according to the inflation. If interest rate is 11%, and inflation is 3%, then the investor will get what? 14%, 11 plus 3. Interest is 11%. Whatever is the inflation, that much they will add and pay you. Coupon, that is called. Here you are protected against what? Here you are protected against what? Inflation. Investor gets protected against the inflation. Finance logic. Finance logic. Why the government wants to control the inflation? This is the reason. No one will invest in your country. If your inflation is high, see, every person at least, see, I will give you one simple example. The thing what you can buy for 100 rupees today, and the inflation is 10%, and the inflation is 10%, that means after a year you will have to buy that for 110. Let's say the interest on the return what you are getting from the market, here inflation is 10%, let's say it is 6. So if you have 100, you invest it, you will get 106. Please understand. So obviously you can't beat the interest. There is a war and you are not beating the interest. Sorry, inflation. You are earning how much? 6%. But inflation is 10%. Therefore the government tries to control the inflation. No? It pinches. Floating rate. Floating rate bond. As I said, what is floating rate? LIBOR. Correct now? IDBI has issued this. ICICI has issued this. India has MIBOR. Have you heard? Mumbai Interbank Offer Rate. Mumbai Interbank Offer Rate. In this type of bond, interest rate is not fixed. It is floating depending upon the market condition. Correct? You get protected against the interest rate. If interest is high, you will get more. Means the borrower will pay more. The investor will get more. Correct? Floating rate bond. According to the market interest rate, they pay. Okay? If the interest rate are low in the market, then the investor will get less. So he is hedged against what? Against the volatility of the interest rate. Against the volatility of the interest rate. Is it clear? Okay. There are already many institutions which we have spoken. There is State Finance Corporation. Okay, State Financial Corporation. Then there is National Small Industries Corporation Limited, NSCIL. There is IFCI, Indian Industrial Finance Corporation of India. Okay, these all people were formed to what? To provide long-term financial assistance to what? Industries. But they couldn't perform in India. We have so many. So today, this is the first day where you will be hearing this name, IFCI. Have you heard? Have you heard State Finance Corporation? If you have heard, it is good. If you have not heard, then congratulations. These are all formed for what? To help the industry. Okay, fine. You have to submit the report we discussed. You have to make a report, project report, and you have to submit. You have to speak in that report about what? About your technical feasibility, about your economical feasibility, about your commercial feasibility, about your financial feasibility, about your managerial feasibility. Okay, how much you are feasible, comfortable at your level. Okay, this type of loans are, this type of loan means what type of loan? From the long-term financial institutions. There are many institutions who provide. SIDB is there, IDBI is there, IFCI is there. Okay, TUFS is there. Do you know TUFS? TUFS. Anybody knows? Technology Upgradation Fund Scheme for textile and for the jute industry. Okay, there was one company. It was a textile company. So we applied for the loan through this institute. So there are many things you don't know. Okay, fine. We'll stop here. Thank you so much.